In today's video, we're going to talk about how the fuck to use stock options when hiring. I say the fuck because most people have no idea, especially if you're my clients where you have a profitable bootstrap company. You maybe even haven't used options in the past, but even people who are really experienced with this, I think, struggle with figuring out how to use them. So today we're going to walk through a specific example where we use options to find someone really, really talented. And this is likely going to be part one. Let me know if you're interested in part two. It's going to cover a slightly different situation. But kind of the mood of today is we want to make people offers they can't refuse so that really, really strong and experienced people join your team, even if you don't necessarily have the cash for it, but you have other things that you could offer and you can be a little creative. Quickly about me, I'm Ugis. I'm a founder turned headhunter. In 2020, I exited an 8-figure online business. Since then, I've been helping founders build their dream teams and have helped more than 100 8 and 9-figure businesses hire true A players. A few examples, we hired Ald Hormoz's marketing director for one of our SaaS clients. We got an executive from Fuel really interested in joining our client who was starting a new business line in the meal replacement vertical. And we got one of the Goalie's top guys to join our client. If you don't know, Goalie is a $600 a year supplement company. Yeah, so let me tell you a bit about the situation, a bit the background where we use these options to learn this really experienced person. So that company was a 2 million ARR. Honestly, that's lower than what we normally work with. The cool thing about them was that they had grown organically. They haven't even really switched on Facebook ads. And so they're as profitable as a company would be maybe 5 times their size. So it actually made sense for them to start hiring these really experienced people and bring them on their team. They're in the consumer subscription space. Let's leave it there. And yeah, for this specific hire, they needed a really technical person. So they had grown on Patreon, which was really nice to get them off the ground. But as they were maturing as a company, they needed their own platform, and it was painfully clear because of the limitations that Patreon has. They were looking for someone to own their product and tech, and I would say product was more important than the tech. I would consider them a marketing and a product company. For both of those reasons, they're really, really interested in the customer experience, right? From a marketing perspective, how to get more out of their existing customers, and from a product perspective, how to give them more. And then the tech side was almost secondary, at least when we started out, where they knew they want someone strong enough that's able to own the tech piece, but they weren't trying to build something truly innovative. They just wanted someone that's solid, and especially in the age of AI, right? They can get away with a lot by using AI. So that's where at least we started. We brought in a strong candidate that matched the initial brief, right? Amazing product guy, knew exactly what the customers would be interested in. On the tech side, he was maybe 7 out of 10, meaning that he's on the software engineer level. Definitely a technical guy, definitely has done it before. But would we trust him with the architecture? When it really came down to it, the answer was not really. He would be the most senior tech person in the company, and we were just more comfortable with someone a bit more senior. Brief shifted to finding a CTO level person, and that's what we were able to get. And luckily, one person responded that was on the CTO level. He still was really great at product decisions, but on top of that, really strong technically. We validated that by having him be interviewed by my old CTO, who was my kind of gold standard for what a great CTO should look like. And he gave us the 2 thumbs up, said, yeah, this guy is the real deal. You can definitely work with him. That was really helpful, by the way, because neither me nor the founders are super technical to that level where they can evaluate CTOs. So yeah, really shout out to Giannis for giving us that extra boost and extra confidence in going with this person. Now we were in a situation where we liked the candidate, they liked us. We still weren't 100% sure, right? Because it's helpful to know that he's strong technically. He was saying all the right things. We liked him. He liked everything about us, the entire situation. We were not able to afford him. We didn't quite have budget for a CTO level salary, at least not in terms of cash. But he was quite interested in receiving options of the company, and the company was totally willing to do it as well. But the company was totally new to options, so they kind of were going with this approach of, hey, let's start a trial. So let's make sure that were really the right fit. We'll figure out the options later. And rightfully so, the candidate was hesitant because he had other options. There were other companies he was interested in, and those options or those companies had clear offers as to what he'd be getting. And here he'd be signing up for 2 weeks, rejecting other offers that he's worked on getting, just to potentially be really disappointed at the end. At this stage, we were in a position where we had a candidate, he was interesting, and we didn't really have a clear offer. And from his perspective, he wanted to know what the offer could look like, how the upside would work, what risk he was taking, and was it really worth pausing his options. He wasn't screaming, "Show me the money," but I was really advocating for him because I didn't want to lose this awesome candidate just by not putting in the work and not being clear enough upfront. The founder luckily agreed, and she said, "Okay, let's figure it out." But I know nothing about options. Truthfully, I know a little bit about options, not that much, but I don't think there are that many people that know it, especially in the really relevant context to yours, right? So there wasn't a funded company that had done it 100 times. Bootstrap companies usually don't do this. Luckily, we did have an advisor who was more knowledgeable than us. So the three of us together kind of put our heads down and try to figure it out. And this is what I sent to the founder, and I think this could be quite relevant and interesting for you to understand, because later she said, yeah, this really clarified things for me, made me understand what I'm even signing up for and what we're doing here. So here's how I broke it down to her. Elsewhere, the candidate's probably looking at 180K base salary, maybe 200K. We were willing and able to offer up to 12K a month, so 144K. That's 36K that we're short. The next year would be maybe 40K because he'd have some inflation increase, up to 52K in year 5, which was the period we were looking at. We had to make that essentially shortage work somehow. And on top of that, since it's not money in the banks, it's not base salary, we should give him some risk premium, right? So if you add up all the numbers, put some risk premium on top, that worked out to about 300K over 5 years. So that's what we were trying to come for while offering an upside, right? We're making the difference in terms of the salary that he's getting and offering upside. So suddenly from we're not quite able to afford you, but we have a cool company, we're vibing, come work with us. We gave him an offer that's objectively better than what he could find elsewhere, or at least to the right person, it would seem that way. Some people would choose the higher base salary anyway. He was quite entrepreneurial and willing to go for it. So our offer suddenly got a lot better. And then to figure out what that offer should be exactly, we created some baseline scenario that would be kind of equivalent to what he'd normally receive. And then the optimistic scenario where he'd get much more than anywhere else. We used 1-year cliff and 4-year vesting, meaning that for the first year, he's not really getting any shares in the company. So we're making sure, okay, this is a type of person that is in this C level and that we want to have on our company. And after that, a 4-year vesting period. And then there are some clauses about acceleration in case of an acquisition that could be thrown in. Claude said to do it. I didn't know what to do here. The founder ended up consulting with her advisor, and they worked this part out on their own, which is perfectly fine. Definitely, I thought there should be a clause about valuation, and there are standard practices. But essentially, what we're trying to do here is, hey, in case that person needs to sell those options back to us, what happens, or how valuable the company is. There are some standard practices. There's 409A valuation. I don't know what that means. I could research it if I wanted to. You can do it yourself. Again, what made sense to me is to base that valuation of contribution margin. Why? Because the alternatives revenue doesn't really make sense because the company's about to turn on Facebook ads, really grow in terms of revenue, not necessarily grow that much in terms of profit. So yeah, it adds some value to the company if there's more revenue, but it doesn't make it 10 times more valuable if that revenue is coming from Facebook ads. There's not as much profit generated. Profit at the same time would underrepresent the value of the company because their approach is, hey, we want to see how far we can take this. We're going to reinvest all the profits that we make into growing the company. Just be a metric that underestimates how valuable the company. Contribution margin is what made sense to me. At first, Claude was pushing back and saying, yeah, I don't know if that's a standard practice. Then I kind of asked Claude again. It's backpedal heavily. So I think to me, it still makes sense. But again, I'm just a guy who's saying what makes sense to him. Definitely consult with someone who's more experienced. But I think it's helpful to break this down and make it make sense from your perspective and the candidate's perspective as well. So what we ended up doing is figuring out what the company is worth now, what the company would be worth in the base case scenario 5 years from now, and what it would be worth in the optimistic scenario. And then we know whether to offer 1%, 2%, 0.5%, because we know what that is worth. Because people often ask me, hey, should I offer 0.5%, 1%, 2%? It varies differently from what those things are worth in the moment and what they will be worth projecting a reasonable scenario. You want to work your way backwards. Okay, what are we comping for? And that's what we're trying to figure out here. Yeah, like I said, it's just some guy's opinion, but the founder did say it was really helpful to get this breakdown. And I was heavily spitballing, and obviously I didn't know all the considerations that they might have, but I think this formula and this approach made a ton of sense. And now we were in a stage where instead of a vague offer, we had something very specific. So instead of saying, hey, do the trial, we'll figure out later, that's not that great from the candidate's perspective. It is easier for the founder. They don't have to really think about it. They're like, okay, yeah, trust me, bro, it's going to be fine. But from a candidate's perspective, there's just not that much clarity. But then just by having a few discussions back and forth, we were able to figure out the base, figure out the upside, exit points for both sides. And it did take more work with legal to actually put it into writing and have it be formed properly from a legal perspective. But at least we knew what we were doing. And that work they could do while the trial was happening. Essentially, they'd agree, hey, here's the structure. All the details on the legal side we'll figure out as the trial's happening so that we can move faster. There's another helpful concept that I would call playing not to lose versus playing to win. And the idea is that if you're not really trying to figure out the offer up front and you don't want to risk it, you don't want to make a mistake, you're playing not to lose. That's not the best approach to these things. Really high level people, they want to play to win first and foremost. They want to see that you actually have the goods. You have the self-belief that, okay, I have a track record of decades of essentially figuring stuff out as it comes. This person's meeting you for the first time and they're like, well, yeah, seems like they could, but it's always just safer to have that figured out. And that's playing to win, where you know that, okay, a smart person would agree, a smart objective person would agree to those terms that I'm offering, and you come in to the conversation from a position of strength. And one last thing I'll leave you with is, if this position is a real bottleneck, which is, by the way, is the only time you should really be hiring on the highest of levels. You shouldn't be hiring when you're not solving a bottleneck for your growth. Waiting is really, really expensive. So, I mean, the stats and the research say it's double the salary that you're talking about. In some cases, I think it could be significantly more. So you do want to move and you do want to figure things out so that your company can grow. Step one, get clear on the right person, figure out what it is that you really need. We did that. At first, we thought, oh, product only, tech is kind of optional. Then we realized, okay, we need someone who's great at product and great at tech. That's what we did in step one. Step two, we figure out the offer that a reasonable person would say yes to. And like I said at the beginning, there's a lot more to know about offering options when hiring. If you want to learn more, let me know, leave a comment, and I'll create part two. This part covered the situation when you're trying to go for a senior hire, but you don't really have the cash to hire them. Part two would cover a situation that's more so stems from aligning the incentives better. So if someone's joining you on the C level or a really important role, you want them to be bought in, you want to be winning together, and you want them to incentivize them properly. And essentially you're giving up a slice of the pie so that the pie can get bigger and eventually everyone is better off. So if you want me to break down a situation like that, leave a comment and I'll do so. And in the meantime, if you got a key role to fill, let me know, book a call, the link's in the description. And in any case, thank you for watching, and I'll see you in the next one.